Hi everyone. So I'm Sakit Pereira. So I'll be your lecturer for the fundamentals of financial reporting subject. So you must be coming from different backgrounds. So say now for an example, some of you would have done commerce for your A levels, but there will be certain some of your students who haven't done commerce. So don't worry because under this subject, we'll be learning the basics again from the beginning itself, and we'll be covering all the basics. Then after that only we'll be going into the tough areas that is there under this subject. So my plan for this subject is how I'll be teaching is I'll be teaching you all your chapters that is there under this subject. Then after that, we'll be providing you a workbook as well. So workbook is basically in that workbook you will have lesson wise or chapter wise questions targeting your exam. So obviously when we are done with a lesson, we'll be covering all the workbook questions as well. So say you finish chapter 8 and then we'll be doing all the questions related to your chapter 8. Then apart from providing a workbook, we are going to provide you a tute as well. So in that tute, I have included all the details, the stuff that you have to know when it comes to the fundamentals of financial reporting subject. So while you are doing your lesson, so you have a chance of obviously purchasing that tute, and so while you are looking at the recordings what we have uploaded, you can obviously go through the tute as well, and then I'll be uploading these slides as well what we will be doing under each chapter. So again, so what I want to tell you is if you haven't come from a commerce background, don't worry, we have gotten you covered, because under this lesson we'll be starting off from the beginning itself. So we'll be learning the basics, then after that we'll be going to areas which will be a bit difficult, but we'll be uh, properly explaining you how to do those areas while focusing on your exam as well, and how to prepare for your exam depending on questions that you're gonna get. Okay, so to get started off with, we'll start off with our first lesson, which is Introduction to Financial Accounting. Okay, so we are gonna again learn the basics. So don't worry, some of y'all may find this a bit boring because y'all have already done this for commerce and all. But again, we'll learn the basics, and then from the basics, we'll develop our fundamentals going ahead. Okay, so to get started off with, we have under the first section the context and the purpose of financial statements for external reporting. So under your first lesson, or when it comes to accounting, we learn a really important concept, that is what we call the business entity concept. Okay, so business entity concept. What does business entity concept means? So business entity concept means in accounts we consider the owner and the business as two separate elements. Look at the side I have included. So here it says business, the owner. They are two separate elements, that they are not the same. Now keep in mind when we are preparing accounts, even though a business belongs to the owner, when we are preparing accounts, we don't prepare it for the owner, we prepare it for the business. So as an example, what I can give you is, now for an example, say owner is taking something out of the business. So we call those drawings. Okay, we use a term called drawings. So drawings also we have to account. Even though the business belongs to the owner, we still account drawings. Because why? Based on business entity concept. In that it says business and the owner are two separate elements. Okay, so that is a really important concept. Get that into your head, because going ahead you need to know that we are preparing accounts not for the owners but for the business. Okay, and also if the owner is putting more money into the business, we call that additional capital. So additional capital also, even though it is own money, we still show that. Okay. So then afterwards, another section that we have to cover under this section is the business entity types and the legal structures. Now, you all would have heard know what is a business. So normally a definition would be businesses. So you all would have just memorized or remembered business. You get together with a group of people and you run with a profit motive. No? So there are different types of businesses. Okay. So under accounts we learn you have sole proprietorships, sole trade businesses, partnerships, limited liability companies. Okay. So these are different types of businesses that you come across in your day-to-day life also. So sole proprietorship, if you take, sole proprietorship is where a single person carries out business activities. Now you would have seen these small kades and all on the road. So how that works is one person starts the business, or we call the mudalali. Mudalali starts the business. He carries out all the activities. So he has to sell all the goods. He purchases from the suppliers. He conducts all the activities. So that's what we call as sole proprietorship. Next type of business that we come across is partnerships. Okay, so partnerships, what happens is uh, two or more people get together. So minimum of two, maximum of 20 people. Okay, they get together and they carry out a business. So that's what we call a partnership. Okay, it could be any type of business. Could be goods providing businesses or service providing businesses, anything. Next, at last, we have limited liability companies. Now, those are big organizations. So, normally, a limited company could be a private limited company or a public limited company. So, public limited companies, anyone can be an owner. That means if you just go and purchase a share of a public limited company, you become an owner. Okay. So those are big business organizations. So you all would have heard about John Hughes PLC, Hema Soldies PLC, Haley's PLC. Now those are big organizations. Those are what we call public limited companies. Okay. So afterwards, what we will go through is the key differences between these business structures. We'll see what are the differences. Now, first, when it comes to ownership, okay, in a sole proprietorship, only a single person carries out business activities. As you all know, there's only one person. But when it comes to a partnership, two or more owners, you would have minimum of two, maximum of 20 owners. Okay. Afterwards, we have limited liability companies. So, in a limited liability, minimum you could have two, maximum you could have unlimited. That could be, there is no number when it comes to a company. You could have a lot of owners. Okay. So, as I told you, if you go and purchase a share of a limited liability company, you become an owner. See. Okay. After that, when it comes to the liability, uh, in a sole proprietorship and a partnership, keep in mind. So, in a sole proprietorship and a partnership, you have unlimited liability. Unlimited. What does this mean? Unlimited liability. Okay, some of you all maybe, I remember when I was doing my A levels also, I never understood this concept. I used to just remember, okay, sole proprietorship has unlimited liability. Partnership also has unlimited liability. And limited liability, okay, limited liability. But I never actually understood this concept. What does it mean? Okay, so what it means is, now for an example, say your sole proprietorship and partnership, you can't continue anymore. Maybe because you're going to be bankrupt soon. In your business, you have more liabilities than your assets. Okay, in such a situation, you will have to settle on your liabilities. So when you are settling your liabilities, keep in mind you will have to use your own money. That's what unlimited liability means. You don't have a liability. You have you have an unlimited liability. That means now say you're conducting a business by yourself. Okay, you become bankrupt. you obtain bank loans. Now you can't pay off the interest. Now you will have to somehow settle the bank loan that you obtain. Okay. In order to settle, keep in mind your bank can come and take off your assets that you have. Say you own a house or say you own a motor vehicle, they have the right to take those assets because you have an unlimited liability when it comes to a sole proprietorship. Same thing with a partnership. Okay, so I hope you understood that. But when it comes to a limited liability company, say the company becomes bankrupt, in such a situation, what you will lose is what you have invested in that company. Nothing will happen to your assets. Say you invested 10,000 in a company, say that company becomes bankrupt, then you will only lose that 10,000 that you invest. It is limited to the amount that you invested. Simple. So I hope you understood that concept. Next, legal status, not a separate legal entity. So we don't consider this as a separate legal entity. This is not an entity simply. Okay. Same thing with the partnership. Because why? This has unlimited liability. These have unlimited liability. If something happens, the owners will have to come forward and settle using their assets. But when it comes to a limited liability company, we consider that as a separate legal entity from its owners. Okay, so not a separate legal entity. This is also not a separate legal entity. But a limited liability company, that's a separate legal entity. When it comes to regulations, so when it comes to sole proprietorships, partnerships, you don't have a lot of rules and regulations that you have to adhere to. Okay, so the main act that's distinguishing partnerships is the Partnerships Ordinance 1890. Then you have an act for sole proprietorship also. But when it comes to applying those, it's not that strict. Okay, but when it comes to companies, it's more complex because in a company you could have a lot of owners, and the rules and regulations that's applied in a company also are very strict because you can manipulate in companies, you can make money out of companies. So due to that, just to avoid that, they have put more rules and regulations. So when it comes to a company, the act that we have to follow is the Companies Act number 7 of 2007. So that regulates everything relating to companies. So here it's more complex. Less regulated, fewer rules. Next, when it comes to decision making, a sole proprietorship, owners make all the decisions. Owners make all the decisions. But when it comes to a partnership, partners make all the decisions on behalf of the business, whoever the partners who are there. When it comes to a limited liability company, there is this thing called board of directors. Okay, what does board of directors mean? Now, as I told you at the start, in a company, I told you if you buy a share, you become an owner. So there are plenty of owners, okay, millions of owners. Now everyone can't come and make decisions in the company. Even though you are an owner, you hold a small percentage of the company. So how it works is all these shareholders, they set a set of people to run the company. That usually happens in the annual general meeting. They have a voting system and they appoint a set of people. So those are what we call your board of directors. Now in a company, the board of directors only make all the decisions on behalf of all the shareholders. Okay, so they are the managers of a limited liability company, the board of directors. Okay, so I hope you understood the differences. Okay, when it comes to these business structures that you have. Yeah, so that's about it when it comes to the key differences of these business structures. So then after that, we can move on to our next section. Next, we'll talk about the financial reporting definition and purpose. Okay. So here I have given a small financial reporting definition, what is meant by financial reporting? So we have the process of recording, analyzing, summarizing, presenting companies' financial activities. This creates a faithful picture of its performance and financial position. Okay, so we have a set of procedures that we have followed here. So first, what we do is we record all the information. Now, usually we will learn about this process and all in the upcoming lesson. Okay, that's in your second chapter. So usually uh, how we record accounts is, in order to record accounts, first a transaction should happen. Okay, so the transaction we record first. Record in our books of accounts, and we do the analysis. We analyze into different accounts. Now in accounts we will learn there are 5 types of accounts. Okay, so you have asset accounts, liability accounts, equity accounts, income accounts, expense accounts. So whatever the transactions that we identify, we put it into those accounts. Okay, after putting into those accounts, we summarize. Now for an example, say you get the total of your income, total of your expenses, income minus expenses, we get our profit. Okay, so profit is what you have summarized. Summarize. Then after summarizing, you present it. You present in your financial statements. So in a company, you all would know yearly in a public limited company they have to publish their information. Okay, so when they publish, they show the output what they have. So the company's performance they show in an income statement. Company's assets, liabilities, and equity they show in the statement of financial position. Okay, so you present it, and then the parties who are interested in the company, they would look at those financial statements and they would make a decision based on that. Say the company is performing really well, they are making, so last year they made a profit of say 10 million. Now in the current year they have made 15 billion. So there's obviously an increase. No? That, so they would see that increase. Obviously, if you are an investor who is interested in the business, you would go and invest in that business because the company is performing really well, right? Okay, so that is what is meant by financial reporting. Then we'll look at what is our main goal when it comes to financial reporting. So our main goal is to provide useful information to external stakeholders. So we provide information for our stakeholders. What is meant by stakeholders? Have you come across this term before? So stakeholders means the people who are interested in a business. Now, for an example, uh, the person who starting the business, the owner, he is interested, no? Interested in making profits. Then you have managers, employees, investors, government, lenders. A lot of people are interested. Okay. Uh, so normally in financial accounting, what we do is we prepare financial statements. Whatever is that is prepared, we publish it. We publish it to the public. So whoever is interested would go through those information and they would make a decision. So we are providing information to our stakeholders. We call, so we provide normally to stakeholders. Stakeholders two types. It could be people internally inside the organization. That means people like owners, managers, employees, okay, and people outside, such as your investors, lenders, and other creditors. Okay. So we mainly target our external people because we have to get people from outside to come and somehow invest in an organization, or in the business. So the main people who we are going to target is investors, lenders, and you could have the government as well. Okay. So now to run an organization, we need funds, right? So how we collect funds is through our investors. So based on now say if it's a company, if it's your business, you show how well you have performed when you have conducted your business activities. Now, someone who's interested in your business would go through those information. If they have seen, okay, this business has been conducting, earning profits yearly, and that has been increasing. So obviously, if it's an investor, he'll come forward and invest in your business. Okay. And then you have lenders. So lenders are people uh, or organizations who lend the business money. Okay. So when they lend, they have to see the companies or the businesses' ability to repay back that amount obtained. Okay. Now, in an organization, you would earn their assets, liabilities. If they hold more liabilities, they have more obligations, so that they have to repay back. Then that is not a good sign. So if you are a lender, you would go through the SOFT, Statement of Financial Position. In that you show assets, liabilities, and equity. In the company, if there's more liabilities, a lender would be scared to lend money because they know the company is not in a good position to repay back the amount that they have obtained since they hold more liabilities in that company. Okay, and then there's the government who's also interested because through businesses they can collect tax revenue and they contribute to the GDP of the economy. So based on those stuff, the government is also interested. So that is the main goal, to provide information to external stakeholders of an entity for them to make a decision. Okay, so I hope you understood the main goal. Next, we can talk about the users of financial statements. So we have primary external users, other external users, and internal users. So we'll see primary external users. So the main primary external users are existing and potential investors. Okay, the investors, they go through the business's information. You have lenders, people who lend you money. I explained that while we were doing before. And you have your other creditors, such as your suppliers, who supply the business goods on credit terms. Okay. So those are your users. Their role would be to provide capital and assess the risk and return of the investment. Assess the risk and return. So normally, if it's an investor, so he is coming forward and investing money in the business. He's taking a risk, right? He could just keep that money and wait, no, without putting it anywhere else. So he is risking his money in order to get a return, in order to get a higher return instead of keeping the money with him. Okay. So that is the primary role and interest when it comes to the primary external users. Then you have other external users such as your government, customers, employees, public, the community, competitors. So they are also interested in the business. So government is interested to earn a tax revenue. Competitor is interested to see how well the competition is to compete with uh, our, our business or whatever the business organization. Public is also interested to see whether they are providing something to the community, whether the business is doing community services. Okay, so due to those reasons, uh, the other external users are interested in a business. Then you have your internal users. The internal users would be the management and the board of directors. Board of directors, I explained before what is meant by board of directors. Okay. So what they do is they run the company on behalf of the shareholders. Okay. That is when it comes to a company. Okay. So that is their primary role. So I hope you understood the different users that you have over here when it comes to an organization and their primary roles that they have to do. Okay. When it comes to these users. Then we can move on to our next section. So we have different user groups such as your investors, lenders, management, government, employees, customers, suppliers, public, and the competitors. Okay. Uh, when it comes to these people, so what are their primary information needs? What do they need from the organization in order to make decisions? And the key decisions supported. The key decisions that support them. Okay. So investors, when it comes to the investors, or you call them the shareholders, what they need is, what they look into is the profitability and the growth potential. Profitability of the business, how your business is going to grow in the future, whether there's a growth, then only they'll come and invest. And they look into the risk and return as well. So the key decision supported also, they look into the profitability and growth, and whatever the risk that they're taking, the return that they get out of that also, they look into that. Next, you have lenders and creditors. The information needs that they want is the company's ability to repay back the loans and the cash flow stability. What does cash flow stability mean? So they look into, so you go through the cash flow statement and they see whether they generate enough cash flows, cash inflows to repay back the amounts that they're lending. Okay, so normally you have to go to a cash flow statement to see whether they are not in profit. Keep in mind, we will learn we make it to the accrual basis. What that means is whatever the amount relevant for that particular time period, we record. Even if it's not paid even if it's not earned. But cash flows, you record whatever the cash inflows and outflows. Okay. So based on that, you can see whether whether the company is generating enough cash flows. Cash basically in simple terms. Key decisions supported would be the credit worthiness of loans and setting credit terms. So credit worthiness is the ability to repay back the amount obtained. Right? Next, when it comes to a government, they look into their information needs are the taxable income. Key decision supported is they're gonna see, they're gonna calculate the tax owed by the government, not the government, the organization, and they ensure they have to ensure whether the laws are followed correctly by the business. Okay, so that is when it comes to a government. When it comes to employees, their stability and profitability. What they need. So they are going to see in the company whether it's stable, whether they have a future in that company, and also whether they are generating enough earnings for the work that they are putting in. Okay. So key decision supported would be they assess their job security, whether they are secure in the future, whether this job is going to sustain in the future in the company. So you look into those, and they can negotiate pay and benefits. So you can, in a company, you can talk to the managers. Maybe if you're not earning enough, you can say, okay, for the work that I'm putting in, I have to get paid more, and you can negotiate. Maybe bring up your salaries. Okay. Then you have your customers. They look into the long-term stability. Uh, so they're going to see whether the business is going to be stable in the future, and also they're going to see uh, whether the business is going to provide goods on credit terms. So that matters, right? Now, certain businesses, they might not do credit service, but the businesses who do credit sales, they can make more sales, obviously. Then after that, when it comes to supplier, the key information that they need is the ability to repay back the suppliers for the goods that the suppliers have provided. Okay. And key decision supported would be assessing if a supplier is desirable for long-term contracts. So you have to see when it comes to the business, uh, is this supplier more reliable? Is he a trustworthy guy? Can we maintain a long-term relationship with this supplier? So you have to look into those stuff. Okay. The public, the information that they need is they are going to see whether the business is doing anything to the community. Are they giving anything back to the community? Okay. A lot of businesses, they have to do community welfare services. Okay. Because you have to create a good image in the public. Going ahead when you're carrying out a business, that is very important. Okay. Because then only customers will come forward and maybe purchase your goods. Maybe we invested more in your business because you're giving something back from whatever you're earning from the organization. Next key decision supported would be assessing the company's social and economic impact. Yeah, you look into company's social and what they are doing to the society and what they are contributing to the economy. You have to look into those. At last, we have the competitors. They are going to look at the financial performance and the strategy that whatever the business organization is using. Because now competitors obviously will look into how well our company is performing. If our company is performing better than the competitors, then the competitors are at a disadvantage, obviously. So that's not a good sign. So obviously you have to maintain, since in order to maintain a good competition, in order to survive, you have to assess the competition between the firms. And Next is you benchmark their own performance, key decision support. So you do a comparison and so competitors will do a comparison and see where they can work on, maybe to achieve the targeted profits and may somehow maintain the competition. Okay. So this is what we have under this section, the first section of your first lesson. So we learned about the basics. So we went to uh, a very important concept, the entity concept, and then after that we went through the business structures that you had. So we had sole proprietorships, partnerships, limited liability companies, and then after that we went to the differences of those. After doing so, we went and discussed what is meant by financial reporting. Okay, and we learned what is the main objective of financial reporting. So those are again the basics that we learn normally under financial accounting. When we spoke about the the main goal, after that we learned about our primary users who uses our financial reports. So we had primary users, other users, and internal users, people within the organization. And then at last we looked into what are the information needs that they need and the key decisions supported for them. Okay. So this is what you have under this lesson. So I hope you under this lesson, the first section. There is two more sections that is there. So you can watch the next recording. In that you have the next two sections. Here, so again, what I wanted to tell you was, don't worry even if you haven't done account for your higher studies. Maybe you're coming from different backgrounds. Maybe you haven't done commerce at all. But don't worry, we have gotten you covered because we will be learning here from the basics itself. And also, I have provided you can obviously purchase our tunes. In the tunes, while you're watching the recordings, you can go to the tune and make notes in that. And also, these slides also will be uploaded, so you can take a print out of the slides and make notes of that also. And apart from that, as I told you at the start, make sure you do the workbook as well. That is the main part, because main thing is us preparing for the exam, because you need to know how these terms that we have learned, how it is tested in your exam. Okay. So in order to practice for that, in order to prepare for that, keep in mind we have to do questions. We have to practice questions. So those practice questions, lesson wise, we have made a workbook. So each chapter you have questions. So you watch all the recordings of a chapter and make sure you go through the recordings and then do the questions. That is the most important part. So I hope you understood this section. So I'll meet you again in the second video. So make sure you watch the next two sections of this first chapter.